Hello and a wonderful afternoon to everyone. Ramadan Kareem. Thank you for joining us today to understand a little bit more about home financing in the UAE. My name is Eamon Gebre, Head of Wealth Advisory at Sarwa, and I'm here joined alongside a colleague of mine, Daniel, who I've had the pleasure of working indirectly with you over the last few years, and really glad to have you join us today. Daniel, it would be great maybe if you could let us know a little bit more about yourself and about Husby and what your proposition is here at Sarwa.
Yeah, thanks very much, Eamon, and really appreciate the invite. Ramadan Kareem to everybody that's joining us. So just to go back a little bit in terms of my journey here, if you like. So I've been in the UAE for about 15 years now. I've spent 10 of it in mortgages. So I think I wrote my first mortgage in 2008. At the time, we were Home Matters. So anyone that's familiar with Home Matters will see that we're in the process of changing our name. So we had a very exciting end to last year and beginning of this year where we were acquired by Husby. And my role now is a director with Husby, and we're very much about digitizing the mortgage journey. So I guess with Home Matters, our mission was always to make the journey as painless as possible and make it as easy as possible for people to get home financing and go through the property purchase process. But now we're going up a few notches, or many notches, I think, with Husby, where we want to take that to the next level using technology. So Husby's very much a prop tech startup. They've been in the market, or they launched in the market 15 months ago, grown substantially in the mortgage market over the course of particularly 2021. We're very happy to be acquired by them, say officially at the beginning of the year, and now go on the journey of really trying to digitize the mortgage journey and make it even easier for people and make the whole process as online, as easy, as painless as possible.
I can't understate the importance of this, and it's by design that we've asked Daniel to join us from Husby, because I'm in love with the proposition about digitizing and making the process efficient and really, conducive to a quick turnaround when it comes to home financing. I've spent some time in home financing, and it's a very much a manual, paper-driven, process altogether. And I think this is definitely a really good opportunity for people within the UAE to benefit from digitization. I think it's much needed. Would you not say, Daniel?
For sure. And I think, look, in terms of the company, it's, mortgages is a massive part of it, but we very much want to, re-engineer or help improve the whole home buying process. So one comes with the other. It's not just about the mortgage part of it. That's a big part of it for many people, but it's also about trying to help re-engineer that process to make it very easy for everybody. I think it's one of these things that we all hopefully do. We don't often do more than once in our life, or don't own more than one property at a time, and it's a pretty big life experience where it can be very kind of scary and stressful. So we want to help make it as easy and as transparent and as stress-free as possible from start to finish.
Amazing. And I wish you guys all the best of success in this endeavor. For those of you who just come into the room at this point in time, just wanted to say thank you so much again for joining us, and the Ramadan Kareem to you. Today, we're going to be discussing home financing in the UAE 101. You have opportunity to learn about the journey, understand what the qualifications are to qualify for a mortgage, what the fees are, and of course, any other questions that you may have. I'm joined alongside Daniel. I don't want to say it. I'm going to say it last correctly. I already know it, Daniel. So I'll leave it to you.
Daniel's fine.
Daniel, perfect, who's director at Husby, who's going to be guiding us along this journey. And shall we start, Daniel? Shall we jump into the presentation?
Ready to go.
Amazing. Now, of course, it goes without saying, anybody who's attended any one of our webinars in the past, this should not be interpreted as one-on-one financial advice. Every individual's circumstances are unique to them. So it's ideal to have a conversation either with your advisor or have a conversation with your mortgage advisor just to be able to understand, what's ideal and what's, the proper solution for you. And of course, we don't have a crystal ball. So if you do have any questions today about what's going to happen in the real estate market in the next 6 months, I don't know. I've got just as much as an idea as you do, and neither does Daniel as well, because there's so many variables and factors. Now, as a little bit of house rules, we are going to be taking questions along the journey, but we're definitely also going to be taking them at the end of our conversation today. So feel free to, write in your questions into the Q&A section on Zoom, and we'll be more than happy to address it for you. So without further ado, let's jump into the topic of home financing. And I think many of you would be asking, well, why is Sarwa having a discussion about home financing? Are they getting into the mortgage business? And we're not, Daniel, so don't worry, it's not a competition. What we're here to do is really talk about wealth and the building of it. And for anybody who's been with us for some time, we've reiterated the messages about generating wealth to help you achieve your financial goals. And building wealth is multifaceted. It's not a one-trick pony. You can build wealth by investing, of course, through stocks and bonds and Forex through institutions like ours. You could also maybe invest in cryptocurrency. You may be interested in investing in a business, or maybe starting your own business, maybe investing in commodities, maybe purchasing land. Well, today the focus is going to be on property, and as to how you can utilize property to help you generate a bigger net worth, so you can be able to achieve your financial goals. Now, there was a very, a recurring question that came up in our last webinar, and which we hosted a gentleman from one of the major real estate firms here, which was, should I buy a house outright in cash, or should I finance it? And I thought it would be a really great opportunity to expand on this, to highlight what the benefits or the merits are of financing versus buying a property outright in cash. And to illustrate this example, I wanted to show you, and by the way, the benefits of home ownership we talked about, maybe we should actually elaborate on this one, my apologies, is that, one of the benefits of owning a home is the fact that, you have long-term capital appreciation. You can turn this property into a rental, income generating asset. It's a great hedge against inflation. It helps you control your expenses because you have a set fixed expense every single month if you have a mortgage, or if you don't have a mortgage, you don't have any payments that you have to worry about. You don't have to deal with landlords who are changing the rental, requirements every single year. It's a great opportunity to turn a house into a home, right? What greater feeling of ownership, than having, the keys to your door that are yours that nobody can ever take away from you. And it gives you also the ability to have stability, flexibility, and privacy, right? You can use real estate to leverage, and buy more real estate. You can save money relative to spending it on rent every single year. And it's a great way to diversify and also build your nest egg. But back to the point I said about, should I buy property outright in cash versus financing that property, right? So to illustrate what the merits are of financing, I present to you scenario number one. Suppose at this point in time, you've accumulated savings, you've been, squirreling away some money, and you've managed to accumulate the total deposit of $1 million dirhams. Amazing. You can actually have the ability to purchase a property outright at that level here in UAE. And suppose you do. You purchase that property, you're happy, and you decide to stay in this home. You're in love with it. It meets all of your needs, and you stay in this home for the next 25 years. Now, let's assume that there's going to be a property appreciation of 3% per year. And I know for some of you that may think, 3% only. This is factoring in down markets, factoring up markets, and that's actually more realistic when it comes to appreciation of properties over the long term. Now, you purchase this property outright, but you have some disposable savings every single month left over that you're willing to do something with it. Maybe further your investment portfolio by investing every single month into a portfolio of stocks and bonds. And let's go a little bit further and assume that over the next 25 years, you've grown your portfolio at a return of 7% per annum, year on year, like clockwork, right? So you purchased a property, you've invested some, disposable savings of 5,000 dirhams a month, and you've been earning a rate of 7% return on your investment, but 3% on your property. Well, your $1 million dirham property after 25 years, based on the 3% value appreciation, is now worth 2,090,000. Check mark. Great job. You now have an asset that you live in that is worth 2,090,000. Well, what about your monthly contributions? Well, your 5,000 dirhams that you've been putting away, 60,000 dirhams a year over the next 25 years, on a growth rate of 7%, has grown and ballooned to be a value of 3,940,000. Now, in this current scenario, you have two assets. You have your real estate asset and you also have your investment portfolio. Combined together, you now have a net worth of 6,030,000. Spectacular, amazing. You're 25 years later, you have a nice little nest egg that you can rely upon, which is your investment portfolio, and you also have a home that you could liquidate should you need to, should the situation arise. Well, let's look at the same variables in scenario number 2, in which you've opted to finance the property, okay? So property, it's worth 1 million dirhams. You've opted to put a down payment of 20%, which is the minimum if you're a first-time investor here. Not to take away from your, from your portion of the presentation, Daniel, which I know you're going to talk about the minimum requirements, but by and large, as a first-time homeowner, you could get away with purchasing the property with just 20% down payment. And you decide to invest the rest in a portfolio of stocks and bonds, okay? And again, you do the same thing for 25 years. Same property value appreciation of 3% per year, but you're paying an average mortgage rate of 3.5% over that period of time. And by the way, this is average. Some years will be higher, some years are lower. Just use 3.5%. Your mortgage payments over the 25 years are 4,000 dirhams and 4,005 dirhams. And that means you have a disposable savings left over of just under 1,000 dirhams that you can say, you know what? I know I made a lump sum into my investment portfolio, but I'm willing to allocate a smaller portion, a stipend every single month towards my investment portfolio of 995 dirhams. So how does this equate? What's the outcome? Well, again, your property appreciates in value to be worth 2,090,000. Your mortgage cost over the 25 years, based on the average rate of 3.5%, equates to be 401,500 dirhams. Let's remember this number, 401,000 dirhams. Your investment lump sum that you made, which is the 800,000, the leftover money, plus your monthly contribution, equates to be a total portfolio of worth 5,125,000 dirhams. Add this up. You've got your property purchase, that's now worth 2,090,000, plus your investment portfolio worth 5,125,000. You now have a net worth of 7,215,000 in the period of 25 years. And if you really want to be very granular and factor in your interest cost, let's remove your interest cost, right? Altogether, that 401,500, you're still ahead at 6,813,500. And in this scenario, you still own a house and you have an investment portfolio. You've got two assets that you can rely upon, but your net worth is considerably higher at that point in time. Now, we're going to jump into some questions that some of our clients have had in the past that we've shared. So there are some prep questions, but as I said, we are definitely welcoming any questions that you may have. And thank you so much for those who just came in recently into the webinar, and Ramadan Kareem to you. Daniel, anything you want to add on this at all? Any other things that maybe we may have missed out on?
Yeah, look, I think it's a fantastic example of the fact that often buying a property, particularly if it's where you're going to live, is everyone thinks it's kind of with your heart, as it were, which often a big part of it is, but you can also use your head and maximize what you get out of it from an investment perspective. And I think your property is probably one of the only assets where you can borrow very long term at pretty low cost compared to other kind of lending that you can do or borrowing that you can do. So it makes a lot of sense, and you've demonstrated it brilliantly with the examples that you've given, that doing that can then really help you in terms of your overall net worth when you go down down the line, or a few years down the line. So I think that's a great demonstration, and I don't think you factored the rent that you might receive or rent that you might pay into there either, which would then even make that calculation probably better. So it's I think it's one of those things that where obviously I'm biased because I do mortgages, but I believe there's always a really great case, even if you've got the funds, that you look at the mortgage solution when buying a property.
Absolutely. And look, so we do have examples when it comes to renting versus buying, and numbers actually look even more abysmal at that point in time. So there is definitely a benefit from buying relative to just renting for the next 25 years, because that's a sunk cost that you have So the argument just kind of reinforces it over and over again.
Exactly, yeah.
Is a much better option for you versus buying the property outright in cash or renting for an extended period of time. Now, I think it's a really great segue to start really jumping into, okay, well, we acknowledge that it's the right approach. What does a journey look like here in the UAE? And I know some of the clients who are on our webinar today, they've already gone through this journey maybe a few years back. There may be some changes that they may not be familiar with. And for those who are first time, considering to be first time buyers within the region, I think you're going to get a lot of value out of this section here. So what does the home buying journey look like, or the home financing journey look like here in the UAE?
So I think, look, the first part is trying to establish what your budget is, right? So you need to know what you can spend, and this is really based on two factors when you're looking at it from a mortgage perspective: is how much cash do you have available? So what's the deposit amount where you've got to put down the property, plus the fees, and the other part of it is what's your affordability based on your income. So the journey ideally would start with speaking to either a bank, or even more ideally a mortgage intermediary, and establishing what your affordability is based on those two factors. Once you've done that, there's a process called a pre-approval. Different countries have different versions of this, where you may have, if you're from a UK background, and I think possibly other markets, you'll hear decision in principle or approval in principle. A pre-approval in the UAE, generally speaking, is a full credit decision minus the property. So once you go through that pre-approval, it is pretty solid. Like the banks very rarely will go back on that credit decision, because it's not subject often to things like credit scoring or whatever else. They do that as part of the process. Once you've got that pre-approval in place, then you're good to go and put offers down without having to worry that the financing might not come back in, might not come in when you need it once you've found the property. You don't have to have that pre-approval in place to go and buy a property. You can buy it without, but then you're going to be relying on sellers putting clauses into any contract that you sign that give you a get out clause, if you like, should the financing not come through for whatever reason. So we'd always say that, and particularly at the moment where I don't know if I can say it's a seller's market, but it's more of a seller's market than it was 3 years ago, then sellers are going to want or going to favor normally cash buyers to start with. I think that's the same as it's always been. But then after that, pre-approved financed buyers, where they've got a pre-approval in place, because sellers as well don't want to take properties off the market for weeks while people wait to try and get an approval in place. So the first point is getting the pre-approval. Generally, that's 3 to 5 days. You can then go and hopefully find a property, sign a contract, which you'll hear of as MOU, Form F, purchase and sale agreement, all of these different type of terminology, but fundamentally it's the agreement to buy. And then once you've done that, you'll go through a valuation process. So in order to for the bank to assess whether the price that you've agreed is the suitable price for what they believe, or what an independent valuer says it's worth, they will get a valuer to go in and do a valuation of the property. Assuming that then is accepted, or is at the level that you've agreed the price at or higher, then they'll go to what we call a final offer letter. And a final offer letter is basically the unequivocal, pretty much unequivocal offer to lend based on the property that you've agreed to actually buy. Once you've done the final offer letter process, the process then depends on whether there's a mortgage seller on the other side or a cash seller on the other side. But fundamentally, once you've got that offer letter in place, the bank are then ready to lend the money that you've agreed against the property. I could get into the real nitty gritty, but there's a lot of differences depending on, as I say, whether the seller's got a mortgage or if you're dealing with a developer. But to give you a kind of a broad kind of time frame on it, we'd normally say it's kind of 4 to 6 weeks if it's a cash seller, and 6 to 10 weeks or 6 to 8 weeks for a mortgage seller. And that can be plus or minus depending on who the bank is, who the seller's bank is, if there is one, so on and so forth. But yeah, that's kind of the broad journey, if you like, with a financing, purchase in the UAE.
So the process, from what I see, hasn't really changed much, but there's been certain upgrades or certain, I guess, newer solutions that have made the journey a little bit better. And one of those that comes to mind is the Etihad Credit Bureau. Because I believe in the past, we were pretty much in the dark, really, when it came to your liabilities. It was very much old school. There would be a banker going through your bank statement, trying to identify where your obligations and where is this payment going to? Is this a reoccurring one? Maybe you can tell us a little bit more about the Etihad Credit Bureau and as to how that plays a role in the pre-approval.
Yeah, so I guess, in terms of how long it's been around, I think it's about 5-6 years. It might be a little bit longer. It's only really being used in a proper, or what I would describe as a proper thorough credit scoring process in the last 12-18 months, where the actual scores are being looked at. Prior to that, it was being used just to make sure the liabilities that the client had were being declared, and they were, it was listing all the liabilities, whether it's loans, credit cards, car loans, etc. Now the scoring is being looked at. Generally speaking, there is a base score that banks will accept, and that can be different depending on the lender. Some lenders have more appetite to take people with lower scores than others, but that will be looked at, right? The other thing as well, it'll look at your behavior. So if you've missed checks or missed payments, that could have a negative impact on the decision that the lender makes. So there are some additional visibility that we have, and you can run it yourself. So you can go online, download an app for the Al Etihad Credit Bureau, get your own credit report to see kind of if there's anything that you don't know about. Where I believe it's going to have, or where it's already starting to have a real positive impact, is some of the lenders now are using it as part of their online journey, which obviously we want to kind of be more and more involved in, where they're using it to actually help drive the underwriting decision. So this is at early stages at the moment. So it's not it's not massively developed, but it's starting where we've got 1 or 2 lenders where at certain levels of loan, so it's a restricted loan amount and certain restricted conditions, like they need to be employed, they can use the credit score, or effectively credit report, to give the underwriting decision. So it will pull out all the salary information, the liability information, and make a decision. So it's early, it's still slightly early days with this, but this is the direction of travel. And I think the credit bureau, or as it already has, or the credit reports, will be more and more used in the underwriting decisions as time goes on. It's still relatively young if you compare it to UK, US, or more established markets. Their credit scoring has been going on for decades, so it's easier for them to rely on certain information that's more developed. But they're certainly in the process of improving that here, of how they use the credit system. And it's probably one of the big innovations, as you say, in the last 5 or 6 years in terms of the mortgage market here.
No, absolutely. I mean, I had the opportunity to download my own credit bureau report, and I was quite shocked as to how accurate it was. It has all your employment details, salary, address, previous employment. It's like, I don't remember where they got all that information, but I guess everything's in sync with your Emirates ID and visa and whatnot. So they have all this information available. So very useful for making the process much more efficient. And you touched upon how there's other markets, they have different ways of proceeding with the mortgage pre-approval, but there's also differences when it comes to mortgage products as well. So maybe we can highlight a little bit more about what are the different types of mortgages available in the UAE.
Yeah, for sure. So I guess in terms of a broad category, or the broadest category you get in terms of the mortgage products here. You've got fixed rates and you've got variable rates. So at the simplest sort of level, there's banks that will offer fixed rates, and then some that will offer fixed rates and variable rates, and a mixed match of everything depending on the bank. Fixed rates, as it quite, as it states, is it's fixed for a certain period of time. So your monthly installment won't change for a set period of time. Typically, that goes from somewhere to 1 year up to 5 years. We had some at the end of last year, even up to 7-year fixed rates. But now in the market where it is at the moment, it's typically up to 3 years, and you'll get a percentage, fixed percentage for that period of time, and you'll pay the same monthly installments. There's also variable rates. So you have this comes in 2 parts. So after you've finished your fixed rate, normally you will go into a variable rate, and you can also opt in certain circumstances with certain banks to do a variable rate from the beginning. The variable rate is made up of 2 components. One is the margin. So this is the amount which won't change through the life of the mortgage. So it's effectively, if you like, what the bank are keeping. So that's their fixed margin. And then they will normally add on one of the EBOR rates. And EBOR, just for the benefit of anyone who doesn't know, is the Emirates Interbank Offered Rate, and is effectively the rates that the banks lend to each other in the UAE. So a bank-to-bank, bank-to-bank rates. That comes in different components. So it's, there's everything from 1 overnight, 1 week, 1 month, 3 months, 6 month, 1 year. Typically speaking, the banks would link to 3-month EBOR, but there are some that link to 1 month, some link to 6 months, some link to 1 year. Most of them, or the majority, I would say, link to 3 months. They're using this as a reference rate. So your margin plus the EBOR rate will then decide what your total rate is that you pay. And with a variable rate, your rate will, as it suggests, change. And that can be every 3 months, every 1 month, every 6 months. So it's not that it's every minute they're figuring out the rate. It will be at fixed intervals, but it will vary. One example might be you have a 3-month EBOR linked to with a margin of 1.5%. EBOR at the moment, the 3-month EBOR at the moment is just over 1%. So your rate is 2.5% for the next 3 months. And then after that 3-month period, they'll look at it again and then take the new EBOR rate, add that to the margin, and then you'll be paying a different monthly installment for the next 3 months. So those are the kind of, I guess, the vanilla type products that are in the market. And you can, you have options. Different lenders offer different types of options, different levels, different terms of fixed. But there's also some less vanilla products in the market now, or slightly more complex products, or slightly more innovative products, should I say. So we have, some offset products as well, whereby they link your kind of interest payment, if you like, to a current account where you keep money. And the more you keep into your current account, the more you keep against that in that current account, the less interest you pay. So your savings is offsetting your interest payment. So we have a couple of lenders that offer products along those lines. So there some innovations that have come into the market in the last few years, and that offers you the opportunity, or the option, if you like, that if I keep money with the bank and I keep money on deposit with them, then I pay less interest. And these are in access accounts. So it's not that they're locked up, the funds, you can still withdraw it, but on a daily basis, they'll calculate what the difference is between your saving or your deposit and your mortgage amount, and you'll only pay the interest over and above what you've got in your current account. So again, these are quite interesting products, and certainly we've seen a big kind of increase in people taking these type of products.
Have you ever come across clients asking for fixed rates that mature and then they're able to renew it back into a fixed rate? And I say that only because I remember I used to get these queries quite often in my previous role where clients were exposed to other markets in which they had fixed rates that, for example, you could take a mortgage for 3 years. You can decide at that point in time whether you want to renew it for another 3 years, or maybe you want to opt in for 5 years again for a fixed rate. And they will repeatedly go through that exercise until the mortgage is completely up. Do we have something like that here?
So there are some lenders that within the documents will say we will offer you another fixed rate, but it's not stipulated. So often it just is down to the lender at the point where you come to the end of your fixed rate. It's whether they want to renegotiate that rate with you. So you can choose at that point if it makes sense to move to another lender. So you can do what we call a buyout or a mortgage transfer. Or you could approach the lender and say, look, I'm finishing my fixed rate. There's better rates in the market now. What can you offer me? What's the best you can offer me? And many of them will want to retain clients. So they'll offer some form of fixed rates. And then it's a case of comparing it to what the other options are in the market versus what the costs are to actually change to another lender. There isn't really a very formal process like it. Again, go back because this is where my background's from, but in the UK, lenders will have a clear option at the end of at the maturity of your fixed rate. This is the next set of fixed rates that we're offering. Do you want to take it or don't you want to take it? Over here, it's a little bit dependent on the lender, and you go through like a retention process, and it's more instigated by the borrower rather than always by the bank to say, what do you want to do now? Banks are normally quite happy to leave you in your variable rate if you don't say anything.
I got you. There was an interesting question here raised. I mean, I think it's very fitting because it sounds like it's it's a very involved process to try to figure out which product is ideal for you when it comes to your mortgage needs. And there was a question by Abs who said, well, what are the benefits of going through a mortgage broker versus going to the bank directly to kind of figure out what my options are?
So I guess in the easiest explanation is that a mortgage broker or intermediary has access to the whole market, whereas if you go to your own bank or any bank individually, they only have access to the products that they offer. And so that may mean you get the best option in the market, but it may not. And a mortgage intermediary should offer you the whole, or offer you a very wide range of the market. I think there's something like we've got a product system that we maintain, and there's I think something like 1,600 different mortgage products in the market, and that's spread across like 25 banks. So if you were able to go and just happen to end up with the right bank at the right time, then great, but it's changing all the time. And one lender that we're using quite a lot yesterday, we might not be using a lot of tomorrow because the rate's not as good, the product's not as good, there's other options in the market which are better. And it's our job, or it's the job of a mortgage intermediary, to give you the best recommendations of what's available to you at that point, without bias towards any one particular lender.
Are there any situations in which the mortgage intermediary receive favorable rates for their clients and relative to a client going there directly?
Yes, I think, look, I can, certainly speak from the perspective of Home Matters Husby. So what we had previously with Home Matters and now with Husby is that we've had exclusive rates with certain lenders. So it's not every single lender, and it's selected lenders, but where we bring volume, we can demand better terms for our clients. So because we're aggregating the market, we're bringing a lot of business to the lenders, then one of the things that we ask for wherever we can and push the banks for is to get some kind of special conditions for our clients, whether it be through the rate, through processing fees, through whatever means that we'd look to get some special terms.
Amazing. And just one last one I want to pick up right now, Pierre. Yes, this is being recorded and we will be sharing it out to everyone. So yes, absolutely. What I'll do is I'll move on to the next question that we had prepared, Daniel, which is the down payment requirements to obtain a mortgage. There's been some changes here, and I guess also some confusion from some individuals as well. But maybe if you can walk us through what entails the down payment requirements to obtain a mortgage in UAE.
Yeah, for sure. So the major change happened in 2020. So just after we were just as we were going into lockdown, I think the central bank increased the loan to value, or the maximum loan to value, so the maximum you can borrow on your property, from 75% to 80% for first time buyers. I'll come back to the first time buyer bit because it's interpreted slightly differently by different lenders, but ultimately they increased the loan to value by 5%. That was up to a purchase price of 5 million. Above 5 million, they increased it from 65% to 70%. So they added in 5% effectively on each of the previous brackets, where it was 75 or 65 and 75, depending on whether the purchase price was above or below 5 million. So above 5 million, lower loan to value, 65% has now gone to 70, and below 5 million, it's gone from 75 to 80. For second mortgages, it's pretty straightforward. It's 60%. So any subsequent mortgages to your first one are 60%. Now, the first time buyer rules are interpreted quite differently by different banks. So some apply it to the kind of the most strictest way of looking at it. And I won't name names, but your former employer would be one of them that I mentioned. But they will say, look, if you've ever owned any property at all, that they will basically say that you're not a first-time buyer. So you actually have to go and prove by going through the Dubai real estate app that you've never owned property. Most other lenders will say, as long as you haven't got a property with a mortgage, then we will treat you as a first-time mortgage buyer, if you like, right? And we'll allow the 80%. Some, if you've ever had a mortgage registered at all, they'll say again, look, you're not a first-time buyer. Now, it doesn't mean you drop from 80 to 60. Normally, it means you drop to 75 if it's your first property. There are ways certain lenders allow you to move things around. So let's say you're already in a property now, you've had it for a long time. In reality, because the market's appreciated over the last couple of years, it's at 60%, and you're looking to upgrade, and you're going to keep the place that you are living in now, and you're going to rent it out. We can, there are lenders that we can go to that will say, look, we will do a valuation on the first property, make sure it's 60% or below, and then we'll let you treat that as your second property, and then your next one can be at 80%. So there are some workarounds, but I guess the at the top level, it's 80% is the highest loan to value. This is for expats, I would add as well. For UAE nationals, it's 5% higher across all of them again. So 85% for under 5 million, 75% for over 5 million, and 65% for second property. So if we look at that the other way, then your smallest deposit as an expat buying over here is 20%. There is also the fees that you need to factor in. And I know we've got a question about fees later, which we'll talk about, but there is a possibility to finance some of those fees within the mortgage with certain lenders. And it's actually quite a lot of lenders now that are offering the sort of option where they finance the fees, and they're not just giving you like a personal loan or whatever else to cover it. They're actually adding it onto the mortgage.
I've seen that actually pick up quite a bit over the last few years.
Yeah.
And it's funny because we're looking at a 20% down payment, whereas other markets are able to allow you to purchase a property with as little as 5%. So I think anything that we can do here to kind of help individuals, acquire their first property, I think it's a really positive sign at the end of the day, right? And there's sufficient equity there at the end of the day to be able to justify lending, to an individual at that point.
Yeah, I still think that, there's some scars bared by the lenders over here from 2008, and that's why they're perhaps not moved back up to the really high, 95% loan to values that you see in other markets. But I think again, I would hope anyway that the more mature this market gets, the more comfortable lenders will be in coming back to higher levels of loan versus the property.
Now, on that, just an extension on that question about down payments, what are acceptable sources of down payments for a property purchase?
Yeah, so in the UAE, generally speaking, as long as you demonstrate that you've received the cash or whatever, into your account here, then banks don't really go, into great detail, right? They'll do your general kind of money laundering checks that you get with wherever you deposit funds, whether it be in the bank where you're taking the mortgage or another bank if you have another bank account. There are one or two lenders, particularly the international lenders, that will take it to a higher level because they're applying kind of, I guess, a higher level of due diligence or KYC on the down payment. So they may want to know full source and track it back. So if it's been transferred in from the UK, where was it based in the UK, or transferred in from Europe, where was it in from Europe? That's a smaller number of lenders. Most of the lenders are happy as long as it's available in the UAE, that they can, they don't do too many more checks on the down payment after that, and don't mind if it's gifted from friends or whatever else. The main no-no, or the one that is not accepted over here, is if you're borrowing for the deposit in a personal loan. Yeah. So that's explicitly not allowed by the central bank.
Yeah, I mean, essentially at that point, you're just increasing the amount of debt load that you have at that point in time, right? I mean, you're qualifying, and more often than not, I've seen people are qualifying to as much as possible from a mortgage perspective, but you're also in conjunction taking out a loan. I mean, from a risk perspective, right? I mean, you have to consider the bank. They're saying, well, this person's got two liabilities that are on the go, and that's a concern. So I can understand it from that point of view.
Yeah.
Sorry, go ahead, Daniel.
No, and I just say, look, the one thing I would say is that if you're borrowing that money against another property, i.e., you have a property that's either paid up paid up, no mortgage, or a small mortgage which you can borrow more on, then that would be acceptable for deposit. It's only for an unsecured loan where the banks really don't want to have a mortgage plus an unsecured loan.
Got it. There was a couple of questions, and they're sort of related, and I'm going to pose them to you, Daniel. Right?
Yeah.
And one of them was that, well, what happens if I'm unable to pay my installments? And that's by a gentleman of just his name is past slipping me right now, but it was asked as to by Usman, who said, what happens if I'm not able to pay my installments? And then the second question by Pierre, who said, what are the implications of having your salary being credited to the same institution that you're taking a mortgage out of? I think they're kind of related in a sense there.
Yeah, I think so. And I think I'll start with the first question, which was, what if I can't pay my installments? Look, my advice, or our advice, has always been to go and approach your lender and work with them. Despite, I think, what some people think, lenders don't generally just want to foreclose and take people's property, because it's a legal process. It takes a long time, and you'll probably remember back in your days involved in mortgages, repossessions here are not like, you don't pay one payment and the next day the lender gets the keys and they kick you out. It doesn't work like that. There's a legal framework around it. Actually, lenders, generally speaking, try and avoid going down that path, and they will try and help people to continue to make the payments, whether it be giving them a break from paying, maybe the capital, restructuring the debt, making it longer, whatever. Most lenders will try and accommodate to help people, if they get into any kind of difficulty. We've seen that, to a certain extent during the pandemic as well. So a lot of people, were not earning or or not able to pay their their mortgage installments. And I know it was kind of under decree of the country, like they didn't have a huge amount of choice, but I think even if they hadn't been told by the government to do, I think most of the lenders would have offered payment breaks or kind of deferred payments on the mortgages, because they genuinely don't want to, genuinely don't want to go through repossessions en masse. It's not good for the bank. It's not what they want to do. They don't want to suddenly become property owners, right? Stuck with a load of property with bad debt on it. It's not what most of them, or what I believe most of them set out to do.
Yeah, I mean, it's very costly, it's very time intensive. It's also unpredictable because at the end of the day, the bank does not want that asset on their books. They're not a property management company. They don't want to have, multiple keys, they have to try to figure out which house is, which keys for which house. And more often than not, they tend to send it for auctions, which is unpredictable as far as what price you're going to receive for that property relative to the outstanding mortgage. So it's not something that they're in favor of, but it's really more of a last resort, if anything else.
Yeah, and I as I said, I would always encourage people to, the first port of call is work with the lender, approach them, say that I need help, let's see what we can do, rather than, trying to ignore it or think it's going to go away. And remember now that, your credit can be impacted over here, which, if you get something that's really bad on your credit, it might prohibit you from, even getting credit cards over here in the future. So I think it's one of those ones where definitely go back to the lender. On the second question, this will depend on whether there is a mandate for that salary to be transferred or not. So there's something called a salary transfer letter, which lenders will sometimes ask for a mortgage. Nearly always for a personal loan, you'll be asked for a salary transfer letter. But for mortgages, they'll sometimes ask them, and it often comes with some, additional perks. Maybe they reduce the processing fee, or you get a slightly better rate. Now, the danger with this, and where we always ask people to think about it, is that when you mandate your salary, what you're saying to the bank is that my salary will continue to be paid to you, right, until and unless I leave my employment. And if I do leave my employment, the end of service benefit will go there, and you as a bank are effectively in control of that until such time as you're happy to let me continue. I provide documents that, give you comfort that I'm going to be able to continue to pay the mortgage. So doing a salary transfer mandate to a bank can be something that you might not help you down the line, right? You decide to change jobs, whatever, that could cause you some issues. So we certainly not, it's not that we don't recommend it. We just want people to understand the implications of doing that salary transfer. If people then say, fine, I'm comfortable with that, and I don't think I'm going to be in a position where I might leave, then, no issue with it. But certainly something we want to make sure people are aware of. If you don't have a salary transfer mandate, then effectively there is nothing tying your salary to that mortgage. So you're free to move that wherever you want. So, that shouldn't cause you any problems. There is potentially a situation where, because the bank has your mortgage and they happen to see that your salary is going in there, then maybe it could cause some issues. But generally speaking, without a mandate, it shouldn't matter where you're working. They're not going to ask to, if you move jobs, they're not going to know that you've moved jobs. As long as the salary keeps coming or the payments being made on the mortgage, there shouldn't be a problem.
Let's take this a little bit further. Because another commonly asked question, such as part of the presentation deck, I think it's a perfect time to ask. Suppose I decide to move away, but I haven't sold my property, still have a mortgage outstanding. What are the implications of that to me?
So if you look at it from what will be in the mortgage terms and conditions, so with every mortgage you get your offer letter, which is kind of, sets out the interest rates and, any early settlement fees and things like that. Then behind that will be a broader terms and conditions. And in most cases, or many cases, the bank will stipulate that if you have any change of circumstances, such as leaving the country, that you should inform the bank, right? Now, it doesn't necessarily stipulate what could happen in that scenario. It's just that you should do it. In reality, or in practice, then in most cases, as long as you're able to, or you continue to service your mortgage and you don't have a salary transfer mandated to the bank, then it's unlikely that they're going to want to create any problems, right? Because essentially, you've got a debt that's being paid. There's no challenge from that, that you servicing the loan. So why would they want to? What would trigger any kind of discussion? The one thing that you just have to bear in mind is that if you have a current account here, then often the bank will ask you or a lot of banks will ask you to renew your visa for your current account. So what you should do as a minimum is move to or open a savings account, which has not got a visa attached to it. So I think I actually watched part of one of the previous webinars that you had, and I think this came up in discussion, but there are some banks that will offer non-residents accounts, but it's on a savings account basis. And then you attach your savings account to make sure the mortgage can be picked up from there, and it shouldn't cause you a problem. Now, the letter of the law, or the letter of the contract, should you say, rather than the law, is that often they'll say that you should inform. I think it's about applying judgment. There are some lenders, again, the international lenders, where they are less concerned about where you are. They don't have specific terms and conditions about saying you need to inform them of anything. So if it's something that's a real concern and people, really think, well, if I'm away, I just don't want any kind of risk at all, then there are lenders, we have lenders in the market where those kind of terms are not included.
Thanks for that, Daniel. I'm getting a few questions about off-plan properties. I think might be a good opportunity to kind of address them. One of which you're asking about, are the LTVs different for off-plan properties relative to, I guess, in the resale market or in the secondary market? An extension of that is, what's the maximum LTV? And number 3, GCC nationals versus UAE nationals. Are they treated as the same, or are they treated as expats? So maybe it's many questions, but let's start with the first one. What's the difference from an LTV perspective for off-plan properties?
Yeah, and that's an excellent question, and there's a lot of properties that are handing over in the next sort of 12 months, so I'm sure it's going to affect a lot of people. So as long as it's what we call a final payment, so payments into off-plan properties can vary. So it used to be quite commonplace where there'd be stage payments all the way through the building of the property right up to completion. Now it's far more common that you would pay 30-40% down during the construction phase, and 70, 60, whatever on handover, and variations around that. There's no one form fit. It depends on the developer, the development, and it can be slightly different. If, for example, you have a handover payment where you've got 80% to pay on handover, then you can go up to 80%. So you can take the full loan to value quota, assuming it's your first mortgage and it's below 5 million property, then you can go up to 80%. The banks treat it as if it's a purchase from that perspective. However, if your handover payment is less than 80%, it's normally restricted to what the amount of the handover payment is. So if you've only got 40% left to pay, then the banks will only normally finance up to 40%, irrespective of the fact that maybe even based on the value, that might even be less than 40% in today's market. There are some lenders, just to make it slightly more complicated, that will say that, look, we'll lend you the balance payment, and then once you've gone through the process to get your title deed, we'll then equity release or give you back some of the payment that you've already paid to the developer, but we're not going to pay it to the developer, we're going to pay it to you after the title deed's been given by the land department. And that amount will vary depending on different lenders, and you have to, now for equity, there's specific purposes that you can use it for. One of them is sort of refurbishment property. So normally they'd give an amount which is reasonable to be refurbishing a property. Some people might say, well, if you've bought a brand new property, why are you refurbishing it? I can tell you there's a lot of people that actually end up completely refurbishing their properties, even though it's brand new.
I want a swimming pool in my living room.
Exactly.
Well, then on the, so what I understand is that from an LTV perspective, it's the same, really, whether it's a secondary market, whether it's offline, it's the same. Now, I guess when we're talking about GCC nationals versus UAE nationals and expats, where do GCC nationals fall in when it comes to LTV approval?
So GCC nationals are still treated as expats from a loan to value perspective, other than obviously UAE nationals. So there's no kind of treatment that's they don't get any special treatment or don't get the same kind of loan to value option as a UAE national. There are certain developments which are restricted to GCC nationals. So there are certain facets where it's GCC specific, and there's also for GCC residents, if you like, or GCC national and residents that are not necessarily residents of the UAE. There's more lenders that will lend to them as non-residents of the UAE than you would do with, other non-residents, i.e. outside of the GCC.
Sorry, can you elaborate on that one? I got lost when you said.
Yeah, sorry, that probably didn't explain it.
Yeah.
So if you had someone that is a Saudi living in Saudi and working in Saudi, then they will have more options for financing than, say, a French person living in France and applying as a non-resident.
I got you. Okay.
Because there's lenders that they still treat them as non-residents, but there's just more options. They're more comfortable lending to people that are resident or nationals that are resident within the other parts of the GCC.
Understood. Okay, great. We're winding down. We've got a few minutes left. What I want to do is I just want to make sure we cover some remaining questions here. Now, from an eligibility perspective, we've covered down payments, which is really essential. I mean, highlighted this as being one of the first things to look at your affordability. But what about from an eligibility, a credit eligibility perspective? What are banks looking for? What are they looking at?
So if we break this down into two parts, so we've got salaried and self-employed. So if we stick with the salaried segment on its own, then what the lenders are checking is that they check it from two sides. So there's an overarching rule which says you cannot borrow more than 7 times your salary. So if you take 7 times your annual salary, your mortgage cannot be more than that, or your overall mortgage exposure can't be that. But then they check also your debt servicing ratio within that. And what the debt servicing ratio is basically you can only borrow, or your repayment on your mortgage can only be up to 50% of your monthly income once you've also taken into account any other liabilities that you have: car loans, personal loans, credit cards. Credit cards are the one that kind of often throw people out a little bit, because the bank, what they do, they don't care whether some of them have slightly different rules, but generally speaking, they don't care whether you pay your credit cards off every month or not. They're looking at the limits. So they'll take typically 5% of the credit card limit and add that to your debt servicing as a liability. So if you've got, a 100,000 dirham limit, that's going to look like you've got a 5,000 dirham monthly repayment effectively, which would form part of that 50% that you can't exceed. So credit cards are often the ones that trip people up, but they can be reduced, they can be conditioned. So it's not a major issue. It's just understanding what the limits are, how much people want to borrow, where that fits in with their debt servicing. And then if you need to condition anything, then you can do. You've then got, so I think that's it's fairly straightforward, and certainly a lot more straightforward than compared to when you go into self-employed. Self-employed, again, varies a lot more per bank. So it really depends on, whether, I guess, broadly speaking, whether they have financial audits or don't have financial audits. So they don't have a third-party auditor, if it's just the management accounts of the company. And then it's normally a computation of turnover. And again, this can vary to bank, and it can vary quite wildly. So we have certain banks that will restrict the income or what they'll assess as an income for 10% of the overall turnover, and we go right up to 60%, which is a massive difference. And they'll apply something often called industry margin. So depending on the type of industry, the type of business, that will dictate whether it's the 10%, 15%, or 20% turnover they look at. So with self-employed cases, we could spend an hour going through all the kind of ins and outs of how these are assessed, because it's different per bank. This is where I think more than anything, a mortgage consultant, a good mortgage consultant can help you, because you could go and knock on 3 different doors with banks that it doesn't fit their profile or their policy for self-employed. You give up, and actually there's one there that will definitely be able to help. It's specific to the circumstances of your company. So that's that. I know that's probably not a really clear answer on the self-employed side, but I guess fundamentally what the banks are looking for is what's the revenue of the company, and then what kind of percentage can we apply to that based on the kind of industry that they're in.
No, very helpful. I think actually it's a great segue to a final question that we can address, because we are over the time allotment. At this point, it's 5:30. And I guess the last question was more related to a mortgage intermediary and mortgage broker, as far as, what do they charge, right? I mean, I think we already addressed an earlier question as to what the benefits are for going with a mortgage broker, but what are the fees applicable for a consumer to proceed with a mortgage broker versus going to the bank directly?
So I think, look, in terms of different mortgage intermediaries have different kind of charging structures. So I can't necessarily speak for everyone in the market. I think if I was going to give a kind of what we do and kind of, I think it's what a big chunk of the market looks like. Generally speaking, it will depend on the level of service that you want from a mortgage consultant. So we offer completely free mortgages, whereby we take clients through the selection process. So which is the right mortgage for me, get you approved. And then from that point, we're more reactive in our service. So we don't get as much involved in the process with the after you've found the property. We'll help. We're certainly there. We're not just abandon people, because we want to make sure they've got support, but it will be more on the kind of reactive side rather than proactive side. We then have fee options where it's more proactive. We stay with the client through the process, almost right up to the end. And if we have what we call a full service option, where we take people, we're there at transfer. So it depends on what people are looking for. And I think for me, that's the right way to structure fees for this type of market. For more complex cases, then certainly we do normally structure some fees in there, but we just try and make it fair for the client, fair for all parties, because particularly with very complex cases, you can spend a lot of time structuring the cases, going for everything, getting someone approved, and they decide not to go ahead, and there's a lot of time spent in doing that. And then you effectively, if you don't have any fees, you do it for nothing. The one thing that I think should be common amongst the market, and certainly is the way we operate, is that our fees are based on getting something. So if you're paying for a fee, you should be getting a pre-approval. It's not just you pay a fee and then whatever happens, you don't get anything. We always put a condition, or there's always a condition that we have to fulfill to get that fee, because ultimately one of the skills of the mortgage consultant or intermediary is making sure that we understand the case, and we're not just throwing it into the bank and hoping for the best. We should be taking on cases and placing them in the right place. So our fee structure is very much about success. So there should be a condition that's met in order to charge the fees. But I'll reel back to the fact that we do plenty of mortgages where we don't charge any fees, particularly for you know, salaried clients or clients that are very experienced in the market, and it's not their first time, and they're happy to sort of get on with it, and they just want help finding the right product.
So you would just more or less act as a broker, but you wouldn't necessarily hold their hand through the journey. And in that scenario, they wouldn't be incurring any fees.
Correct.
This has been enlightening, Daniel. Really appreciate it. How can our audience reach you? You know, should they go to your website? Should they contact you directly? What's the best method to proceed with if they have any more mortgage queries?
Yeah, so for sure they can contact me directly. So you're going to have to probably leave my surname up somewhere because I have my email, so I don't know how these can be, but it's dan.lamoligue@husby.io.
Let me put that in right now, actually. Sorry, I've got your email address here. It's the one at Husby, correct?
Yes, so the dan.lamoligue@husby.io. I got away with it before with Home Matters, where it was just Daniel at Home Matters, but now unfortunately we're in a bigger company and there's more than one Daniel and Dan. So it's dan.lamoligue@husby.io. That's the one. That's perfect.
Yeah, I've just shared it on the chat with everybody else in the audience. Amazing. And we were saying with regards to an alternative method to reach you, would it be?
Yes, so you can go to. I would fully encourage people to go to the husby.com website. There's a portal there. If you want to test out our online capabilities, then by all means, if you get stuck at any point, there's something that says, you know, I need some help, and someone will be in touch with you. But yeah, for sure, I'd encourage people to go through the husby.com website. It's a really nice tool, and hopefully it will be helpful for people that, you know, want to try and do as much of it themselves.
Amazing. And for the audience members, this is recorded, so you will receive a copy of this recording in your inbox very shortly. Thank you for joining us, and thank you so much for your questions. I apologize if I wasn't able to get to everyone's questions, but we are looking forward to hosting more of these types of events in the future. And just want to say thank you for joining us, and Ramadan Kareem.
Ramadan Kareem. Thank you, Eamon.
Thank you. Have a wonderful day, everyone.
Thank you, everyone.